Okay. Hello. Hello. Do you hear us,
Hello,
Martin
good
and
afternoon.
Katie? Yes. Well,
I can hear you. I can hear you very well.
do you see us?
I can see you.
Perfect. This works. Great. Welcome back. So I would like to welcome you all to this session, which is our policy session on rethinking global finance, which is organized within the framework of the Iwfsas conference. Let me start first of all to welcome Karel Lano. Karel Lano, he's the CEO of SEPS, my colleague for many years, and we've been working together since 2001. And it's really great pleasure to have you here. This is actually our first meeting in EMEA premises, and I'm very happy to have you with us physically, and also we have other colleagues on screen, and of course we will listen to Kathleen and Ulrich based on their keynote speeches for yesterday and today. So let me introduce this policy discussion. In fact, what we have learned over this couple of days and also what we've seen over the last years, the world is really in the midst of convergence of crisis, going from climate change, also geopolitical instabilities and fragmentation, debt distress, also more social inequality, which are very challenging. And they are very challenging, is particularly in our financial system, on the resilience of our financial systems. So in reality, if we look a bit back, I wonder whether the global financial architecture is really enough to deal with those global challenges nowadays, which in reality, what we have developed is an integrated, or call it interconnected financial system. We try to have these global regulations, financial regulation, also global financial infrastructures. But then these polycrises that we are living in, they are really challenging these premises. And in fact, the world of today is not anymore the world that we have experienced many years ago, and we have to be aware of it. So the session today, in fact, it's really inviting us to take a step back and think collectively. And I think this is one exercise that not only economists and finance people should do, but also other disciplines in science. What really, I mean, the question I'm asking myself also, what would the global financial system look like if we would devise a really cooperative, collaborative approach to achieve resilience? I think this is one key question which altogether we need to think of. We heard from the research today that the hegemonic type of powers is leaving I would say, or maybe they are reinforced over this years to come. But then the multipolarity is also a collection nowadays of a struggle for power, what Elise was mentioning. And what Kathleen was saying is, right, we need to really think in a positive note and try really to build the system that we really want, and to ensure that not only we are, I would say, exploring what are the systemic gaps that hold us back, but to think innovatively of different mechanisms and different governance structures and financial instrument and regional cooperation mechanisms also to align finance with long-term global priorities that we want. So all of this will make us think, and I have today the pleasure again to introduce Karel. Karel has been working on financial policy in the European Union. He also had has a broad view on competitiveness in European Union financial systems. And also in terms of the global arena, in fact. Karel, you've been involved for many years now on these debates, since I don't know how many years now, since you started working on those elements, and also you have the perspective of history, so you are by training, you have this long-term historical view. So how do you see the global financial systems in terms of, for example, where the EU financial reforms are taking us, and what would be the EU financial system between brackets heading in the years to come within this era of fragmentation and deglobalization? So to you.
Okay, thank you, Reem. Pleasure to be here this afternoon. Sorry I couldn't be here earlier, but as Reem was saying, I'm CEO as well. Sometimes you have other issues than very interesting things to focus upon. You have to think about finance, personnel, and so on. But yeah, anyway, I'm here. Pleasure to be here. Fantastic place. Let's say just a beautiful place. I wish I could work here rather than in Brussels, because in Brussels it was rainy, windy, and cold. So fantastic to be here in a sunny place and to have a bit the bright side of life. What I wanted to do, speak a bit about this whole debate about, my slides have not totally come through in the correct way, because if you send it from one system to another, it changes sometimes a bit. I mean, Reem asked me to speak about the global financial architecture. I'm already, of course, more a specialist in the European, a bit of a specialist in the European financial architecture. But look at this the global financial architecture from a European perspective. We're preparing a report on this whole debate about simplification in finance, which is also a debate which has started in Brussels since about a bit less than a year, since I would say end of November last year, when von der Leyen made her acceptance speech before the European Parliament. She said, we will propose omnibuses to simplify EU legislation. And that's what the EU is doing. I don't know how many omnibuses we have got already. Politico said this morning we will have a whole stream of omnibuses, let's say of a whole train of omnibuses, and that's basically what is happening. Some of them are already being discussed in the Parliament. They provoke a lot of debate. Also because the whole question of what is simplification has not been defined. And that it's a very tricky issue. And you may have read, for example, also before yesterday, was a vote in the European Parliament on one of these files where the Socialist group in the European Parliament all of a sudden didn't back the EPP. So, and there was whole accusations, both sides, let's say, why didn't you support us, etc. But it's a very acute debate. But that's why it's very interesting to think about this in a European perspective. What could simplification be in a European context? If I go to my first slide, yes. So, as I'm preparing a report on the subject, we had to think about this. If you think about international standards in finance, you're basically surprised they're extremely recent. The Basel Committee dates back to 1974. Was started by the group of 10 countries because there was a big crisis with the German bank, Herstatt Bankhaus, all of a sudden collapsed. In 1974, group of 10 countries, which is composed by Japan, the United States, and all the other 8 European countries. Just imagine this. The international financial system was basically Japan, the United States, and 8 European countries, of which also Belgium, which was at the time probably a more important financial center than today. Of course, the Netherlands, Switzerland, France, Germany. I don't think Spain was part of it. Italy was part of it. The UK, of course. But that was the group of 10. The group of 10 proposed standards for the banks in 1974, 75. The first standards which came out were rules on supervision, of international banks, how to cooperate home-host, basically how to exchange information between supervisors. Then we had in 1988 the Basel I capital standards. What is the minimum capital ratio for banks? Until today, 8% on risk-weighted assets. And then we had Basel II. I remember I was once in a big debate in the United States and New York University where we were discussing for the first time the internal models that banks would be allowed, rather than to have kind of very explicit calculations, implicit calculations would be based on their own models, how much capital they would have to set aside. Why is this so important? Because that was basically one of the causes of the financial crisis. Because we allowed banks to use their own internal models, which not many people could really control, which then basically led to the financial crisis. For example, Dexia Bank in Belgium was a clear case, which had almost no capital, but since because of risk-weighted assets or because of internal models, they had to have almost no capital, the way they thought, the bank collapsed. But it was not the only one, there were many more, which then led to Basel III in about 2010, which had the tighter definition of capital, but also had this output floors, meaning a limitation to the use of internal models. Why do I mention this? Because there is no whole debate about simplification. If you have internal models, it's just the opposite. It's complexity. And that's what we've seen in this entire process. It's not only internal models, but if you think about risk-weighted assets alone, and when I started working, which is a very long time ago, I remember one of the first reports I saw on Basel, at that time, Basel II, no, Basel I, it was Basel I, was the Danes which were asking for lower capital requirements for mortgage bonds. And they wanted to have a 35% weighting. You know, a normal weighting is 100%, government bonds are 0%, and then mortgages maybe 50%, but then they were asking for 35%. That was already in 1988. But that was the first element of complexity. Now we speak about a CRD6, which is the current EU Capital Requirements Directive, number 6 already. Huh? That is the 6th version of capital requirements for EU banks. Then try to apply simplification to something like this. Then you see it's almost impossible. But that is only banking. We should speak about finance and overall. We have IOSCO, which is the cooperation among securities commissions, which is much looser than Basel, which doesn't have the same form of standards as you have in the Basel context, in the banking context, which is 1986. So recent. And the insurance supervisor is 1994. So we have global banking, global securities markets, global insurance since more than 200 years, I think. Or we have global banks since, when is it, the times of the Medicis, 500 years ago. But the standards are basically only 40 to 50 years old, not even. And the current standards are only 10 years old. So just try to imagine then, you say, we have standards which are 10 years old, current standards for banking, and we want to simplify already. Give me a break, I would say. So, but in addition to that, what is not so much in the focus, we hardly have internationally accepted accounting standards. So you want to compare bank balance sheets in the EU and the US, you cannot compare them because they're done on different accounting standards. Of course, we have an accounting standard at European level or at global level, the international accounting standard, but which applies only for listed corporations and only for consolidated accounts. Even within the EU, we don't have a single accounting standard. There is a variety of accounting standards. And if you do now look at the corollary of accounting standards, audit, we don't have a single audit rules. We have some agreement on audit rules. There is no single audit rule, and there is no single supervisor in the EU for the audit profession. And of course, the Big Four, you know, they're extremely strong. They do all they can to fight against this, that there would not be a single supervisor of audit profession. But just imagine, you're an investor in the stock markets, you want to know whether the audit report of the company you're investing in has been well done. But it'll be very difficult to know because there is no kind of real open standard. Or you want to check, look, do they apply certain standards? Will be a very difficult task to do. And of course, you have different degrees of enforcement, which then leads you to the question, how could I ever compare? And that's what I did in a commission seminar only, next slide, only a few weeks ago. I said to them, look, if you want to compare, for example, the capital of the two largest banks, say the one in Europe, the largest in Europe and the largest in the United States, you know that according to the data which I get, I could almost not do it. So I asked the question to ChatGPT. It's fantastic. That's the result I got. It's not my result. That's what ChatGPT told me. Because it is, if I were to challenge you, compare me, JP Morgan, BNP Paribas as an analyst. Do your work on the basis of different accounting standards just to make them comparable. I think it takes you a few days, at least. And if you want to do it well, a few weeks. So I asked the question to ChatGPT. That's what we come out with. So even if we have Basel standards since a very long time, 40 years, I cannot find immediately the comparable capital of BNP Paribas compared to JP Morgan. What I get is what ChatGPT told me that in the end, and that's what the Americans tell us now, is that, say, the minimum capital or the real core capital which JP Morgan has is about 7%, and the one for the European bank is about 4%. So what they call the real tangible equity, not the weighted, but the tangible equity. But then you have the, I mean, you see there are differences in calculation, and that's why it's so difficult to compare. I was sitting when I was presenting this next to Veronique Ormegiano. You know, Veronique Ormegiano worked for BNP Paribas. Of course, she said, no, you cannot do this. You cannot use ChatGPT for that. But the other person from the commission who was sitting on the other side said, obviously you do this. If you're an analyst and you're sitting in Wall Street or in London and you want to have the comparison done rapidly, you will use ChatGPT as well because you don't have the time to make the comparison. Should I invest now, tomorrow, or after tomorrow in one of these two banks? That's the way you will do it. And that's the information you get. But it just shows that it's until today, we have 500 years of global banking, 200 years of large banks, 40 years of global standards. You cannot compare banks because the ways in which you look at it is different. Next slide, please. So what has the EU done? The EU has, of course, followed these international standards at the level of banking, insurance, capital markets. And yeah, that's what we, as I mentioned it already, we have it for banking in 6 different versions of what they call the CRD, the Capital Requirements Directive, and the Capital Requirements Regulation. They have become extremely complex. I challenge you, if you wanted to become a CFO of a bank or the CEO of a bank, in principle, you have to sign up on the accounts of a bank on your own liability. You have to know all what is in there. And if you want to read this last piece, which is CRD 6, I think it's about 500, 600 pages. I mean, impossible to read. Recital 1 is already 1 page long. So you're supposed to know all this if you're a CEO or CFO of a bank. But you have 6 versions already of capital requirements. And the last one was adopted in 2023 with the deadline for implementation in 2035. Imagine already, just because there was so much lobbying to have a single standard in Europe. We have it for insurance with Solvency 1 and 2. Solvency 2 is also being implemented now. There we had only 2 different versions so far. For the markets, capital markets is what they call ISD, Investment Service Directive, which was replaced later by MiFID, MiFID 1, and then later MiFID 2. So this is the core rules for finance in the EU are these 3 blocks, but each time extremely comprehensive, a whole set of regulations with hundreds of implementing and delegated acts. And that's, but I come back to that in a moment, is the problem which we have at the moment. And also what we've seen, it's become much more rules-based. The EU is supposed to be principles-based. The EU has become much more rules-based, so very much nitty-gritty rule-making at European level. And also because we have harmonized this, at European level, not at global level, we have comparable banking data since about only 15 years. So if you want to compare banks in Europe, you can do it since after the financial crisis. Before the financial crisis, I also said it in this banking competitiveness seminar of the European Commission. When I started working in SEPS, I mean, we used OECD data. There were no EU data. Bank statistics data from the OECD. There was the only source of data in the 90s on banks. Since the financial crisis, we learned our lesson. We have comparable data, and the ECB has fantastic data now today, but it was only after the financial crisis. Before the financial crisis, once Daniel Gross came into my office, well-known economist at SEPS. Karel, I want to have a consolidated bank balance sheet of European banks. We didn't have it in 2007, 2008, when the financial crisis hit. There was not if you were to be kind of commissioner in the European Commission, what are the exposures in the European banking system? Nobody would be able to give you the data. They were not available, just because there was no single standard. We have a single standard now only since about 2010. So next slide, please. And what is then the, say, from a European perspective, the international cooperation which we have? Europe has what they call regulatory dialogues with other jurisdictions. So, of course, I speak from a European perspective. What is Europe doing with its financial regulatory standards in a global context? We have what we call equivalence agreements. We say to other jurisdictions, your rules, if you want to do banking in Europe, if you want to sell securities markets products in Europe, if you want to sell insurance, you must be more or less equivalent. And then you can sell, depending on the rules, or sell almost the entire set of services in Europe if you have an equivalence agreement. However, if you look at the equivalence agreements which we have today, we have one equivalence agreement with the UK, we have about 20 with the United States, we have 12 with China, and we have 8 with Saudi Arabia. I mentioned these examples just to say that this process is extremely political. UK left, Kathleen, you know, unfortunately, and that's why we say the UK will only give them one equivalence agreement. The US is so important, I mean, we cannot look around it. They have 20, almost a full set of equivalence agreements, so we can do business in each other's markets as much as we can, almost. But even with China, we have 12 equivalence agreements. So 12 times more than with the UK, just to give an example of Saudi Arabia also. Just to say that this process, I mean, we have international financial cooperation, but if you simply look at these numbers, it is a political process. It's very politicized. And what you see, for example, we have even extraterritorial action. We speak often of the Americans to be extraterritorial. Europe supervises, since Brexit, the CCPs, which is the central counterparties for the derivatives trading based in the UK, from Paris, because they say, we need to know what you're doing because you're handling in euro derivatives. We need to know what you're doing. And that's basically extraterritorial. It works because they work together well with the Bank of England, but it's something we require these CCPs, if they want to do business in euros, and with euro-based organizations, we need to have supervision of what is going on in London because they are systemically important. But we don't do the same with the United States. We don't dare to do the same with the United States. We do it with the UK, but not with the United States. And they're also systemically important CCPs for the EU in the US, for example. We also have a lot of cooperation in, for example, money laundering, tax evasion. I just mentioned this rapidly, but also there you see a diversity or a very political process. You have grey list, blacklist. The EU has grey list, blacklist, but the OECD has the list as well. If you want to see whether they are compatible, no. Of course, there are some countries which are in both, Barbados and so on, and places in the Caribbean, but others which are on the grey list in the one and the blacklist in the other, or others which are okay in the one list and not okay in the other. Again, you see it is political. And you see it also in the application of the Russia sanctions. You know, we adopted only yesterday the 90 package of sanctions against Russia. If you look at the application of the sanctions, already within the EU is a problem, but it should also be applied in theory by accession candidates. There are about 10 countries which want to become members of the EU, amongst them Turkey, amongst them Serbia. If they want to become members of the EU, they should apply the same sanctions, but guess, do they do? Certainly not Turkey, but Serbia also not. So that is, in fact, kind of a brief view on international cooperation in from an EU perspective. Yes, next slide, please. So what are we then doing now? I mean, we have this current deregulation drive, of which I spoke in the beginning. As I said, it's also that process is very political. It's driven by the Trumpian world. It was announced, as I said, only at the end of November last year. But I think that the first thing we need to do before we can speak about the global deregulation from a European perspective, I think we have to bring the EU's house in order. And the problem as I see it there is, and we shouldn't forget that, I mean, if you look at it currently, you would say Europe has become far too complex. I mean, there's far too many rules. We don't see the forest anymore through the trees. Don't forget, the EU was started as a deregulation process in the early 90s. We wanted to have a single license, a single rule for the whole of the EU, a single stop shopping, as they called it when I started working. That's what they wanted to do. That seems to be forgotten. But I think that is what we have to do back as an EU, go back to basics, why we were started, and go back to the basic principles, which were minimal harmonization, mutual recognition, but also application of rules like proportionality and subsidiarity. Proportionality of rules, try to do what you need to do at European level only in a proportional way to achieve certain goals. Don't try to harmonize everything, and that is a bit a problem. But also a big problem of enforcement of rules, and that's why rules have been interpreted in a very different way across member states very often. And a commission which has been, I think, far too weak in reacting to bad enforcement in certain member states. I think what we should also do is kind of have an MOU, meaning a memorandum of understanding between the rule-making institutions in Brussels, which is the Commission, the Parliament, and the Council, on limiting the number of delegated acts, implementing acts, that they have some common agreed standards just to control the process, which has gotten out of control in the meantime. And I think we need to have a division of labor between the EU and the national competent authorities. We have these European supervisory authorities, we have national competent authorities, but the division of labor amongst them is certainly not very clear at the moment. Anyway, I think we have advanced a lot at European level. As I said, we have no single standards. We have a single set of data. We can compare banks. It's most advanced in banking thanks to the SSM, the Single Supervisory Mechanism of the EU, which is today already 20 member states. Also Croatia is a member state of the Monetary Union. Soon Bulgaria will join, and I think very soon also Romania. Bulgaria will join in 2026, I think Romania the year after. So that's already 23 countries which are part of the Single Supervisory Mechanism. That leaves only 3 Visegrad countries, I think, which are not part of it at the moment. So that's not too many. So that's almost the entire EU, which is also soon part of the Single Supervisory Mechanism and, of course, of the Monetary Union. But of course, in the other areas like capital markets, we see this whole debate about single capital markets or capital markets union, a savings and investment union at the moment. Still plenty of work to be done. And we still have far too many authorities, and that's a problem. And we see it also if we speak about banking integration. There was a big debate in this country with Sabadell Bank, but we have a big debate in Italy as well about the takeover of a German bank. But then imagine there are not only bank supervisory authorities which have to agree with this. We have the SSM, we have the Commission, we have national competent authorities, but also market authorities which have to agree. So before you can do a cross-border merger in the European Union to kind of consolidate European capital markets or consolidate Europe financial markets, you have to have the agreement of at least 4 to 5 to 6 different authorities which have to agree. Of course, that makes it very difficult. And if I then look about only, for example, the ECB, about the case of UniCredit's takeover of Commerzbank, it took, I think, 9 months before there was a statement from the ECB to say, look, can it be taken over, yes or no? I think on such things, that should come out almost immediately, a few days later after the announcement, just to support consolidation, because we need consolidation in Europe. And of course, we need to, as I said, reduce the number of entities involved, have a streamlining of supervisory entities, because of course that maintains fragmentation. But at a global level, I think, seen from this, I think it's far too early to speak about deregulation from my perspective, if you see that the standards are so recent. I think we just have to make sure that the standards which we have, certainly at European level, are well enforced, also at global level are well enforced, because they're only standards, they are not mandatory. I don't see a need really at global level to start speaking about a massive deregulation campaign. Thank you.
Thank you, Karel, for touching upon, I would say, the nitty-gritty of the Union or European Union financial regulatory frameworks, how it is applied. And we can see clearly that there is fragmentation, and it seems to me that we are still talking about mutual recognition and minimum versus maximum harmonization. And with the market or the global financial market fragmenting even further. So in fact, we're moving into what we talked before, a race to the bottom rather than race to the top. And where do we stand between the two? But then at the same time, all the standards that have been applicable globally, they are coming from international standard setters. And since we're talking about the future global finance and emerging powers like China and other blocs, my first question would be, how can we ensure that there is balance in the governance system? We discussed it in the time, and who are the membership of the Basel Committee. I'm sure this has not changed. It has changed, which is good news. So how can we move into I would say, a governance that is much more balanced in international financial systems? And how can we really try to find this interaction between what are the most urgent reforms that are needed within a trend of deregulation. So currently, because of the Trumpian, I would say, model, we're moving into deregulation, and eventually there would be a gap between what Europe should do, what Europe has to do, or what they are required to do because of the Trump trend. So should we really go into that space, race to the bottom, or race to eventually the top, and all the work that has been done by the European Union? But at the same time, we need to think of the emerging markets, where the emerging market is standing in all this debate in the international financial system. So I would like to structure this discussion into 3 themes. The first one is the systemic gap and governance and financial reforms. And my first question is to Kathleen, based on the discussion these couple of days. How do you see the positioning of the emerging markets to ensure that this governance, it's a little bit more balanced and they are much more represented also in the whole regulatory debate in banking finance in general?
There. Excellent. Emerging markets. I think what I see is that global financial stability is being built in the East. So I think a lot of the global South has given up on the idea of a global financial safety net. It was never real. It was always going to be biased. It was always going to be partial. It was always going to be selective. Central bank swap lines are temporary, they're capped, they're discretionary, and they're always late. They're always 2 or 3 months after the crisis has caused the most harm. So what I see in the East is ASEAN is prioritizing financial stability. Chiang Mai is an expression of that, even though in the pandemic, nobody used Chiang Mai. They used IMF because Chiang Mai has too many conditions to it. It's too difficult to access. And even if you succeeded, by then the credit rating companies have downrated you because you asked for it, so that it actually could do more harm than good. So instead, they are more flexibly collaborating now on mutual financial stability and interlinking with each other. This week, it was announced that China, Japan, and South Korea would extend swap lines. Those aren't going to be in US dollar. And they could be, but I don't think they are. And they are actually cooperating with ASEAN as ASEAN +3, plus China, Japan, and South Korea. Now, 2 of those are militarily occupied countries with American military bases pointing missiles at another one. And yet, they're collaborating on financial stability because that's their top priority. And then May 27th, ASEAN came out with a joint statement from ASEAN plus China plus Gulf Cooperation Council. Again, every one of the GCC states is occupied by US military bases. They're pro-American, and yet they want to collaborate with the East on financial stability, on stabilizing growth and prosperity. So that's just what I see, is that they've given up on the idea of a global financial safety net, because obviously the US and the EU and the UK are not honest stewards about financial stability, at least regards the global East, global South. And instead they are, we discussed sovereignty this morning as being agency and optionality, that they are agreeing that they are each sovereign agents responsible for their own actions towards financial stability, and that they have optionality in choosing whether to rely on a theoretical Fed emergency swap line, a theoretical conditional Chiang Mai help, or agreeing with some set of their trade parties that they will jointly stabilize in the event of a problem. And so instead of writing things down as an 800-page expression of rules, They are working towards flexibility and optionality suitable to the response to any particular occasion.
Thank you, Catherine. This is clear from the East perspective. Also, today we have been discussing the monetary sovereignty. So how do you relate monetary sovereignty with the discussion that what Carol was mentioning on the global or a European regulatory framework, and what would be the position, in fact, of the European Union going forward globally?
So regulation is one thing, and I think it was well covered by Karel. So maybe I can complement it by talking about operations. So the other, I mean, central bankers are also, or now have become even at the European level, supervisors, and they do also, I mean, talking about standards, let me add the CPMI, IOSCO, PFMIs, which are only from 2012, and which, yeah, I think have played quite a role over the last 12 years on infrastructures and payment systems. But I mean, if I can talk on operations, what can a central bank like the ECB do on the operations side? And of course, it should do good monetary policy. That's quite trivial. That's important for stability. And then, I mean, there's conventional monetary policy. There's a lot of unconventional. So all the crisis measures that have been taken, but many unconventional or non-standard measures are, of course, always in the background, no? So ELA as a possibility to banks is always in the background. Then we have also programs like the TPI, the Transmission Protection Instrument, which are somewhere in the background. And even if they're never used, I mean, they have a real world impact because the, let's say, funding stability of all the debtors in the euro area is a different one if you have such a theoretical backstop. So there's a lot there also done by the ECB to support financial stability. And swap lines, I mean, we have a network of swap lines in, I mean, with 6 Western countries, no? And those swap lines have been there since 2007, and they have been, I think, interrupted at some moment, but otherwise they were always there. And they are being used, at least. I mean, there's always a question, such facilities, whether they're stigmatized. And let's say the ECB philosophy was always, you know, if some banks use this, it's fine. It destigmatizes. So we had almost always those facilities are used by some banks where you could say, hey, why do you use it? Because you can also go to the market. But okay, we didn't pressure the banks in that direction because saying, okay, it's good for destigmatization, let them do it anyway. And we have always some recourse. And one day where we have a crisis, the others more willingly take it. So then maybe moving even more into the infrastructure domain, there's always a lot of talk on capital market union, saving and investment union. And it's good to make speeches about that. And at the end, you know, we had waves of that. And not so much has happened over the last 20 years, apart from waves of speeches. But we have done something. And here again, in the operation space, T2S, I always mention T2S, Target 2 Securities, which is now the security settlement solution of, I mean, almost all CSDs in Europe. Even Euroclear Bank is joining T2S. And that was a big catalyst for standardization of capital market practices, of post-trade practices. I think T2S has done more than all the speeches together over the last 20 years for capital markets union, and it should be mentioned more often, I think. Then, okay, I mentioned this morning digital euro. I mean, all the things in the retail payment market preserve competitiveness. So digital euro is again the operational contribution. You know, we say ourselves, we as central bank, we act as overseer, as operator, and as catalyst. So in retail payments, for example, we act as catalyst. We bring together the industry. We try to massage the industry into standards, into, you know, outcomes for societies, which is better than others, with, you know, some success, but of course, limited success also. It's not so easy. And let me mention two other things, recent things. One is interlinking fast payment system. I mean, one big development over the last 10 years was fast payment systems in Europe also. So we had the SEPA instant payment standard, I think in 2016, and then we have also an ECB system called TIPS, and we have now the instant payment regulation. All that together means every bank now offers instant payments, and that is a fantastic tool because it's democratic. You know, it's non-concentrational. You know, interbank credit transfer is a payment solution which is so beautiful because it's based on a standard, a scheme, and it doesn't lead to market concentration because it's with the central bank a settlement layer in between for the interbank level, let's say. So that is good, and instant payment brings that to the instantaneous 24/7 world. So this is a fantastic development. And talking about global architectures, I think one of the most meaningful and I mean good ideas which bring together internationalization without creating asymmetry is interlinking fast payment systems. So you have all those 24/7 systems now in all major countries, and because they're all 24/7, they all overlap 24/7 also. So you don't have the problem of different operating hours. And what you need is a link between, and linking them means also having an FX conversion system. And FX markets are typically linked in cross-border payments to correspondent banking. And that's a concentrated business and an expensive business because of lack of competition. And the magic solution is you link those fast payment systems and you organize a competitive FX conversion layer where banks have to commit bid-ask quotes, those who want to, and where the system automatically chooses then the best bid-ask quotes. So you de-link the account services from the FX conversion services and have everything in a competitive space. And the ECB is engaging with two partners to do this. One is the India UPI, Reserve Bank of India, because they are very advanced. They have already some such bridges, and they are very good in IT, and so they're just ahead of us. And the other is Nexus, which is a BIS Innovation Hub project, which wants to set up a multilateral such link. So yeah, in both we, I mean, I should no longer say we, but the ECB is in a exploration phase and should soon decide whether to move ahead with that. And the beauty of this is also it's compatible with sovereignty, because you only create an interlinking component which is under joint governance. And if if geopolitics gets worse, the worst that can happen, and you dislike your partner suddenly, the worst, you throw a bomb on this interlinking component, but that's it, you still have your national components. So you minimize, let's say, those interdependencies. You have one breakpoint that if necessary, you can then use. And the last thing I want to mention is wholesale payments and new technologies there. So that goes in the direction of DLT, what is called wholesale CBDC, which is a bad expression. So wholesale payments in central bank money using new technologies. And there also the ECB has launched something called Pontes, which is an interlinking solution to make central bank money available for 24/7 DLT platforms, which go for security settlement most of the time. which would rely on stable coins. And the PFMI, this standard of the CPSI, also says wholesale payments should take place with central bank money settlement. And that's what we offer for those emerging platforms. So a lot of initiatives in the space of operations. So there's regulation, but operations are also very important. And we can do a lot, for a better monetary system there.
Thank you, Ulrich. Do you have any projects with African countries within all those initiatives that you mentioned?
I would say, unfortunately, not really. We have been approached, for example, by some countries on interlinking also. And so far, I mean, because of capacity constraints, our answer was not now, or we can talk, of course, but we have first, to deliver on interlinking, let's say, with India, or where we have started to work. Of course, we also say that we are engaged with Nexus, and Nexus is in principle, multilateral. So I don't know, Morocco could also join Nexus. Of course, Nexus may also say, okay, we are capacity constrained. We have first to launch Nexus at all before we can then, open it up to many more countries, because onboarding every currency is, of course, a certain act. But I would hope, I mean, it would make a lot of sense, in particular for the countries where there are a lot of remittances and trade, like Morocco, that we have an interlinking solution, because those countries, if they don't have a fast payment system now, they will certainly have one very soon. So it is worth exploring.
I think we are moving into a direction of also creating stable solutions within the financial architecture. So it's moving into a certain direction. Do you see it like this, Karel, or you see more that we are moving into less interconnectedness between the financial systems?
I mean, my answer would be very simple. Migration is always increasing. There's always more remittances. There's always more needs for more forms of payment. We always will have more globalization. Whatever is happening, you cannot stop people if they want to move. And if you were to look at remittances overall in the world, you see there is an enormous increase. So this is related to migration movements. And people want to send back money home, back money to their families, or eventually want to return at some stage. But I think it's always increasing. And of course, and that's what I often say, the whole crypto payments, whatever, evolution is coming essentially from that, because international payments were 10 years ago far too expensive. They are still far too expensive today, certainly for lower off. I mean, on average, you pay 6 or 7% on a remittance if you follow the banking system, which is then the safest form. But 6 or 7%, if you transfer $100, each time $6 or $7 is a lot of money. If you can do it with crypto, 100 to 100, of course, that is a big difference. Of course, it's riskier, but that's why crypto developed in the first place. Of course, we don't see this problem so much in Europe, because we are having all kinds of rules to make sure that you can do these payments without too much costs. But at a global level, it is a big problem. And like you were saying, certainly towards Asia, which is basically demographically the booming part of the world, that's where these developments are happening.
Thank you. So, Julia.
I just wanted to make an observation about UPI, the Indian payment system. I globalized the quantum central bank solution, of which UPI is a component, and that is now running in 14 central banks. Not all of them have the UPI module, but UPI module is running in quite a few African central banks. So once you interlink UPI in India, you can then perhaps focus on easy, quick interoperation with the other UPI central banks.
So we have the solutions. Now what is needed is the political will to move into those directions. So let me move to theme 2, which is the innovative financing mechanism. On screen, we have Martin Kessler. Hi, Martin. We miss you here physically. I hope everything is well back home. So Martin is the head of the Finance for Development Lab, and they've been working on debt, accumulation and debt, and climate finance and development reforms. So how do you see finance and financing, new financing models and mechanisms most promising for example, mobilizing resources in the global south that are really needed to, you know, I would say catch up into this global financial system architecture, so they are not left behind in this new transitions that we're living. Martin, the floor is yours.
Thanks a lot. Excuse me. Thanks a lot, Rim. I hope, can you hear me okay?
Hearing you very, very well. So yeah, just lower a bit the volume. Yeah, you can speak, Martin, and then we'll adjust here.
Okay. So thanks a lot, Rim. Sorry, I was not able to come when I did so. Yes, so I mean to continue on this theme on the debt challenges in developing countries, and the innovation that can be proposed. So maybe let me give you my point of view. We've worked, you know, as an institution in the Secretariat of the Expert Review on Debt, Climate and Nature, which was an initiative started by 4 countries, France, Germany, Kenya, and Colombia. We've also been part of the Jubilee Report, which was an initiative of the Vatican with Joe Stiglitz and Martin Guzman as chairs. And that these reports have allowed to give a picture of the challenges of developing countries in the current debt space and what has made debt a major challenge. And also what's made different from previous crises. I think that one important feature is that debt stocks have risen a lot in the recent past in developing countries, but overall they remain relatively low in a way. If you look at the external debt stock of lower middle income countries, they're about 25% of GDP, lower than during COVID, where they were at 30% of GDP, because growth growth restarted after COVID, not very high, but sufficiently to keep external debt either declining or flat. In low-income countries, it's a bit lower, and so this is not, we are very far from the level that we've seen when the world decided to take the highly indebted poor countries initiative and the MDRI, the debt cancellation initiatives for the bilateral Paris Club and multilateral debt. So we are very far from that. However, I think it's very clear that debt stress is still a major, very important on the agenda of developing countries. You can see it through the priorities of the South African presidency of the G20, where that is it's one of the major priorities. You can see it in basically any global forum where finance minister leaders raise it as a major issue. So why is the case if the stocks are not that high? It's because the cost of capital has increased, and because there's a wave of maturities coming in the next few years, starting already back in 2024, and for the next 3-4 years, very high level of debt service, so higher cost of interest and a lot of amortization. In a context where interest rates are high, that makes it very hard to refinance at the same rates. You need to refinance a lot of your external debt at high rates, which means that even if debt levels are not very high, they can very fast go on an unsustainable path. That's a challenge. And what are the solutions for that? So reducing debt levels, countries, the debt relief in some countries will help, but when debt levels are not very high, when it's a cost of debt, it's not that clear that classic was the case in the early 2000s, that relief is the best solution, is the most efficient solution. The focus has been more on the cost of capital, on reducing cost of debt and extending maturities. And for that, you need to innovate. And then I think that, you asked a right question on asking how to innovate to bring more financing, to bring more innovative financing. I think we've been very good at innovating during the COVID crisis. We're very good at innovating during crisis in general. So during COVID, you had the debt service suspension initiative, which allowed about 70 countries to request for the suspension of the debt service to bilateral creditors, like to private credit, problem, but that's also a significant debt service relief for that period. We had the issuance of operating rights from the IMF, which was really important in in allocating funding to vaccines, to emergencies. So you can real innovation around liquidity. And it seems that it's been much harder in the years post-COVID. I think the global geopolitical tensions have increased the difficulty to innovate. There's also, I would say, bad or dangerous innovations. So the markets are very good at innovating around vulnerabilities. So what you see is currently, markets have reopened after a couple of years where poor countries couldn't issue at all on the market. They managed to open that are collateralized at very high rates. So the latest wave of issuance you can see at 8-9%. Even over 10% for Angola. I mean, you have countries issuing at very high rates that are clearly unstable. And when they are, again, often with conditions, collateralization, which could create further problems down the line. So what can be done is this problem of liquidity and the very high cost of financing. So I think there's been proposals, the IMF and the World Bank have come up with this three-pillar approach to provide more financing from multilateral development banks against a commitment by countries to raise revenues, to invest more, so that more multilateral financing, a commitment by bilateral creditors to provide also net financing and credit enhancements for private creditors to avoid an outflow of private money. So debt for nature swaps has been, and debt for development swaps in general, have been interesting innovation where through the provision of a guarantee by a bilateral or multilateral financial actor, the guarantee allows to take a new cheaper loan, and to buy back existing expensive debt. And the differential between the high interest payments and the lower low interest payments is allocated to objectives, whether they are in terms of biodiversity protection and or education, as was the case recently. So those are, I think, important innovations. They will not change the global. They tend to be relatively low. At a scale that are lower than the challenges, but they can help in certain countries, especially when they enter a broader strategy of extending maturities and refinancing. That was the case recently in Côte d'Ivoire. I think we can go further than the three-pillar and the swaps. I think in the GPD report, one of the proposals is to have a no bailout rules, which means that the IMF and the World Bank would be able to lend large amounts of money, but against a commitment that would not go to reimburse private or bilateral creditors. How it's enforced through the rules of the IMF programs, and or could also be through the provision of credit enhancement. You would help private actors provide new loans against if the interest rate is not too high, even if it's guaranteed, can be up to. I see you. I should finish, but I'm so almost done. So this is I think that there's for innovation, and when there's a political impetus, we can see that it can work. So for example, a recent innovation that was very political, very interesting, and could be generalized in the less political way, is the way the Trump administration is financing Argentina, with quite innovative use of SDRs, and so when there's political risk, you innovate and to lower the cost of financing for the countries.
Thank you, Martin. It was a bit difficult for us to hear everything you said because it's a bit cutting. Maybe the reception was not great from your end, but anyway, we understand that there are a lot to do in terms of the financing mechanism, and eventually this could be taken forward by the international organizations. And of course, when we talk about financial innovations, there is also a part of regulation and stability there one has to think of. But again, while debt is increasing and the tension to have a relief suspension is increasing too, probably that's one of the solutions that can be put in place. Now I would like to turn to Katie Kalogli-Swan from UNCTAD. Katie, what is your perspective on this global finance reform from your work there at UN? And then how do you reflect on the comments from Martin?
Thank you, Rim. I will try to capture UNCTAD's work on these issues in the time that's left. Good afternoon, everybody. Just to double check, you can hear me clearly okay? Fantastic. And thanks for the opportunity to contribute to this dialogue. Sorry I can't be there with you, and sorry I wasn't able to listen yesterday. UNCTAD had their 16th quadrennial conference this week, and the outcome was agreed late last night. So we're all a little bit worse for wear here in Geneva. So UNCTAD, the United Nations Conference on Trade and Development, as many of you may know, was established in 1964 to promote inclusive and sustainable development through the integrated treatment of trade, investment, finance, technology, and more, with a particular attention to the persistent imbalances that face developing countries. And over the decades, UNCTAD has played a role in challenging orthodoxies in global economic governance, advocating for fairer terms of trade, debt restructuring or relief, policy space for developing countries. We continue that work today, pushing for systemic reform of the international financial architecture, recognizing that development finance must not only be scaled, but can best achieve its goals if it's delivered within an enabling environment that serves people and planet. And I want to underline this sort of the objective element here, because why rethink global finance if not to achieve such collective goals? My work at UNCTAD focuses on these issues with particular attention to climate dimensions of development, so I'll focus my inputs on that. It's not news to anyone in this conversation that developing countries have been facing cascading crises: the pandemic, the consequences of the war in Ukraine, climate impacts, a cost of living crisis, escalating geopolitical tensions and conflicts, along with aggressive monetary tightening in developed countries, intensifying what was already an unsustainable situation for many. And we have to remember that none of these particular elements in this list were due to the actions of developing countries themselves, but they are facing the severe economic consequences of it. In this context, emphasize for the world what is already known for many developing countries, that this architecture is not capable of supporting them, whether advancing their development goals, responding to shocks, or ensuring the world is capable of achieving the goals of the Paris Agreement, for example. And looking at climate finance specifically, we see a system which is exacerbating debt distress, limiting access for the most vulnerable countries, and unable to adequately finance activities such as adaptation, which are so fundamental to future financial resilience. So to underline, this isn't just about volume of development finance or cuts to ODA, it's also about the structure of this architecture. High cost of capital, restrictive conditionalities, and growing sovereign debt burdens that weigh down these sorts of value-driven actions. So in this context, calls for transformation have gained new urgency to rethink global finance. And this has led to a proliferation of initiatives, actors, processes that are proposing reforms. If I had to list off the top of my head, Bridgetown Initiative, Accra Marrakesh Agenda, the Nairobi Declaration, there are a number of the Paris Pact, there are a number of intergovernmental multilateral initiatives that are proliferating around these themes. And that raises important questions. Where is momentum building? What gaps remain? Is there consensus? And what happens after the most recent months of economic uncertainty. Since I have the opportunity to talk to you today, I want to present some ideas that we are going to be publishing next week in a forthcoming report, where we look at the structural problems and we identify them in three sort of buckets of the architecture, and then use that as an analytical framework to look at these different proposals and identify where is consensus emerging and where are there persistent gaps that are not being addressed. So the three sort of structural challenges that we identify are first, that most developing countries lack fairer and equitable access to the global financial safety net. Unlike economies with access to central bank swap lines, as we know, most developing countries have to rely on the IMF during crises, even if there are innovative mechanisms. And I mean, for example, the BRICS contingent reserve arrangement that's never actually been put to use. So there are other, of course, RFAs and other mechanisms, but many developing countries still must go to the IMF. In addition, the ability to adopt policies to stabilise capital flows, prevent boom-bust cycles of capital action there is severely limited. And that means that developing countries remain exposed to financial volatility, sudden stops and reversals in capital flows, and persistently high borrowing costs without the stabilising tools available to developed countries. And this undermines macroeconomic stability and limits space for counter-cyclical policy responses. The second structural sort of category of challenge that we identify is the available international finance, particularly for public investments, is often misaligned with national needs and climate priorities. International public finance, when available, tends to be limited in volume, concessionality, and flexibility. This funding is frequently tied to structural reforms, particularly fiscal consolidation, which can undermine capacities for investment-led transformation. And at the same time, prevailing models of development finance increasingly prioritise the mobilisation of private capital, often requiring governments to orient public policies and institutional frameworks around investor needs. Martin was talking about the sovereign debt landscape, and indeed it's become more complex, with many developing countries owing a higher proportion of debt to private creditors on market-based terms, featuring high costs, short maturities, and less accountability within any workout process than in the past. The third category that we identify is the governance question in international financial institutions, and the fact that that remains heavily skewed towards developed countries. It's no secret that developing countries have little voice in decision-making in institutions such as the IMF, the World Bank, and other standard-setting forums. And this limits their access and capacity to shape the access to finance or the terms of debt treatment and macroeconomic frameworks. It's worth pointing out that in southern-owned and led development finance institutions where developing country voice is highest, response to members' needs during challenging times has registered higher counter-cyclical changes in lending than other institutions. I think that sort of echoes some of what Catherine was saying about leadership in coming from alternative places and where we can learn from other models that are emerging in South-South forums. So to this end, the sort of three categories of transformation or reform when it comes to rethinking global finance and the financial architecture is: number one, enhancing access to liquidity and stability tools; number two, scaling up adequate and predictable climate finance and development finance; and number three, rebalancing global economic governance. So with this analytical framework, I don't want to go into too much detail and take up too much time, but I want to highlight some of our key findings. We find that key areas of consensus include the recognition of this need to scale up public international finance, to reform conditionalities that restrict proactive market-shaping agendas, and to address sovereign debt vulnerabilities. Such innovative tools have been mentioned here include rethinking SDR use, including SDR channeling, but also other ambitious proposals exist. Agreeing new levies to resource additional grant-based and concessional funding opportunities. Reforming sovereign debt workouts to ensure timely, effective restructuring and forgiveness where needed. However, there are several critical areas that UNCTAD analysis thinks remain under-addressed. So first is governance reform, second, illicit financial flows and tax cooperation, third is equitable access to emergency liquidity, all of which are frequently overlooked in these official and multilateral proposals. Most strikingly, the issue of volatile capital flows, a major source of financial instability for developing countries, is almost entirely absent from the reform agenda. Despite its centrality to past crises, few proposals offer concrete mechanisms to manage capital flow surges or reversals, which is a major gap, and an analytical gap too for economists doing work on global financial architecture reform. And one final persistent trend that I'd like to highlight is that there is still a persistent confidence in the ability of private finance to bridge the substantial financing gap facing developing countries, rather than being one contributor, despite growing evidence of the need for more reasonable expectations of what can be achieved by such tools as blended finance or de-risking. And this persistent emphasis on transferring risk to the public sector to de-risk private investments often has limited consideration of the potential consequences for public service provision, debt sustainability, and broader development outcomes. So as a result, there's also this notable lack of analysis and a gap in proposals regarding strategies to more effectively balance risk and benefit sharing between public and private actors, particularly through market shaping interventions, public regulation, and ensuring that private finance can be sustainably mobilised for public interventions and goods. I'll stop there, Reem. Yeah.
Thank you, Katie, for such a comprehensive view on your upcoming part of your upcoming reports, and quite aligned with discussions that we had these couple of days, plus what Martin was saying. I would like to move directly to Martin Stuchti, who is the founder of the Land Banking Group. Martin, here we had the chance to talk already about how to include nature positive finance into the future architecture, and based on the work you have been doing over these years. Please, the floor is yours.
Thank you, Rim, for having me in this conversation. Can I be heard? Very good. Yeah, and also thanks for having me, because I might not be the usual suspect in the constellation of this group, because I'm entering it as a technology entrepreneur, at least in my current incarnation, and still. Perhaps it's fair to say that if we can't discuss financial stability without turning our eyes to the question of nature, nature's Minsky moment, the fact that there are substantial, systemic, unpriced risks sitting in the system that may all be very suddenly drive asset reevaluations in a way that they currently can be hardly measured and controlled. And so nature deserves to be talked about, because the current set of instruments that we have in order to invest into the viability and into the vitality of ecosystems is not good enough. But the message that I think I have on behalf of that nature fintech, that emerging nature fintech community, that this might change very quickly in a way that is relevant in the way we think global financial architectures. And in a way, you could argue that the whole nature theme comes into this conversation through different doors. The first one is, of course, the way we have to look at it scientifically, the way climate scientists are talking about the problem today, and the way they are explaining how we see these runaway climate sensitivities, of course, has to do not only with the fact that we see increasing unabated emissions. It also has to do that with the first time we are seeing the weakening of marine and terrestrial ecosystems to such an extent that we see the full temperature forcing and the full ppm forcing effect. And whilst we do have a rough, I don't have a good idea how nature finance can work. I can see it from your faces that my
we hear you.
You can hear me?
Yeah, we do.
Okay. Well, and then the second way in which it comes in is that we already start to see major supply chain implications. We've just today we saw a report on the future of the Brazilian soy basket, which under current projections is likely to be massively weakened by 2035. So with all the ripple effects deep into China, deep into Europe, and the only way to build resilience against that is by to starting reinvest into the health of the soils or into the maintenance of those mosaic forests in the southeast of the Amazon. And again, we don't have a way to fund these investments. Or you could look at it with a perspective of the global south. I just heard the Nairobi Declaration 2 years ago, where one of the major outcomes was that we need to find ways to reward the global south because they are maintaining the key biodiversity areas and all those regulating ecosystems that we need to sustain the global climate system and the stability of the global also financial system. So for all of that, we require one major change, which is a reframing of nature as critical infrastructure. And that also has been the birth of our initiative Nature on the Balance Sheet. How can we get into a world where nature as a stock is recognized on both private and public balance sheets? And the Bellagio process was all about trying to define what such a five-step process could look like. And every time there's interesting things to be said about how these things might be
Again.
possible now in the way.
Yeah, sometimes there are some interruptions.
Yeah.
Yes, now you continue.
There was a clock.
Yeah, you're good.
So the very first thing is, for the first time, there is technology now available that allows us to measure nature. So we have there's a new capability available now to give every pixel of the planet an ecological passport in such a way that we understand the stocks of biodiversity, of carbon, of water, of soil, all those economically relevant driver of stability. So that is possible now through the convergence of resolution as observation, which is really interesting. Now we are able to give them a value, a price, which is due to the mathematical opportunity or the mathematical capability to develop attributions. In the past, it has always been a public good that needed to be protected or that could be accessible to concessionary finance only. Now we can give it an economic value because we know what the resilience or the risk reduction is from every square meter and from every unit of biodiversity back onto fully priced assets. That is new. That allows us to almost build a mathematical chain from nature into our priced asset portfolios. The third one is that there is a new capability now to portray funding for nature as an asset because you can establish identifiability and controllability in the way these outcome-based contracts are designed. That again is new. So nature is not so much anymore just a down payment. It's an investment under normal IFRS global accounting standards because it's a controllable right that you as a company, that you as an investor, or that you as a government can invest into. Well, and then the fourth step on that ladder is that you can actually portray it in such a way that it turns into a security that can be traded through security exchanges. And we are talking to many of the security commissions right now to issue new asset classes that are in fact indexed back to nature. And the very last one is then, of course, governments, which increasingly are recognizing that rewarding an investment position into nature is something that should be considered within the capital requirements that are being held up against banks. So overall, there is now the ability to build a technical, financial, and legal infrastructure that forms the missing link between nature, so that we don't have to just reward it within the context of concessionary finance, that we don't only can fund it in the context of compensation markets, but that we can treat it increasingly more normal as an asset, as other infrastructure asset classes as well. And I think this is also sort of allows a new opening in the political space. What would it take to create national essential infrastructure plans that also include nature, where we would sort of get out of the trenches of nature and climate agenda standing in the way of our economic agenda, but where we also declare the fundamental backbone of ecological infrastructure that we need to keep our productivities, that we need to create to keep our financial stability, that we declare them essential infrastructure, that we give it the same legal status, that we apply the same infrastructure financing instruments to it. And one could even imagine a world where Europe would declare that rather than running their nature agenda just through CAP, just through nature restoration law, just through some of the established and sometimes very complex, I'm getting back to the very first remarks of this session, very complex steering mechanisms, that we choose a radical simplification by giving it infrastructure status and calling it part of our essential infrastructure with all the legal implications that has, and manage it and invest into it in the way we are used to through other asset classes as well. The message that at least from a technical perspective I can give that this that the technical infrastructure that is needed to portray nature as an investable asset is in place.
Thank you, Martin. That's very clear. Now I'm turning to the room for any questions from the audience. They cannot hear you.
I was very interested in the first part and the very insightful speech on the deregulation and simplification. And what was coming to mind was this idea that one of potential reasons to simplify and reduce the infrastructure and so on is that I see that more and more resources are needed to, and knowledge and talent to understand, how the market is evolving in terms of crypto, stable coins, and so on. So I feel that is a very much also a problem of resources that now need to cover more and more challenges than in the past. And the second thing is about what you mentioned about the availability of data. So that pre-crisis, the data were not available. And sometimes I hear researchers saying, we are working because the new data set the ECB is making available, and people at the central bank don't have time to work on that. So I think we also are the opposite in terms of there is too much data and very little time to analyze it. So those are my 2 points.
Turn to my colleagues here. So we have heard from Katie, Martin, and Martin on their additions to this discussion on global financial reforms. I would like to give, we have no more than 5 minutes to wrap up this session because some of you are traveling. I would like to give the floor first to Karel, and then Kathleen, and then Ulrich.
On the questions which were asked or on the other issues which were raised by the others, Rim? Anyway, there are so many things I could develop, let's say also on the issues Ulrich developed, let's say on the issues related to Asia. I'm not sufficiently aware of data as compared to, let's say, as related to Asian financial markets. It's more anecdotal evidence, I know. But just on the question, let's say, of these new, financial instruments like crypto and so on, and the capacity to follow what's going on, I think European supervisors could work much more together in a kind of a coordinated fashion to divide the work. I think there's still a lot of overlap between them, let's say, rather than focusing on the work they're doing. I think I mentioned that the SSM, the single supervisory mechanism, which we have in Frankfurt, for me is a big breakthrough. Some people see it as far too administrative, procedural, bureaucratic. Yeah, but that's the downside of creating a single entity. But I think it's certainly much better than what we did before. I mean, if we didn't see what was going on in the bank, which I mentioned, Dexia, is because it was supervised at the local level, and the capacity to look at these internet kind of internal models was not there. I mean, the capacity to look at, understand how a bank calculated its capital requirements according to an internal model. If you're with the, whatever, 20 supervisors in separate places looking at it, as compared to one, where all the experts are sitting together, of course, you have much more expertise, because to understand an internal model is extremely complex. So for my part, let's say the same applies to what is going on in the crypto markets. And I think the danger is even greater, because we see that there's a lot of crypto being offered from non-European countries. We have no way to deal today with third country sales of crypto products in the EU, for example, or in markets, I mean, and other regulated markets, but coming from non-regulated markets or from other jurisdictions, it's extremely difficult to control. And if they are on our social media, if they are kind of selling their services in ways which we cannot control, it's very difficult to do. And it has happened, and it's happening on a day-to-day basis. That's why, honestly, I am very skeptical about crypto. I think the regulation which we have at European Union level today in MiCA is far too limited. I mean, we need to have much tighter regulation, but it's difficult to do. On the other hand, I see, as I said, crypto is extremely important for the global south to do payment transactions. And of course, if it's more regulated, it will become more costly. That is a problem. So you need to find somewhere an in-between. On the other hand, I mean, I think there's too much fuss on crypto, because I looked at the data recently. The total, I mean, crypto in Europe is extremely limited. If you look at one element, stable coins, because I had to speak about this last week, stable coins in Europe is about 280 million. In the United States, is hundreds of billions. So it is yet not developed in Europe. And the whole debate is now, let's say, the US pushing it to have further development, or say further placements of its debt. That is part of the problem. On your second question, which was on too many data, I don't think so. We can never have enough data. I mean, it's just a matter that, of course, I mean, if you're sitting like us as a researcher, I mean, on a desk, you have hundreds, thousands of data coming to you. You have to select it. And the thing is, you have to select from credible sources, because there is plenty of rubbish out there. And that's what you need to do all the time. Certainly also with what you get on social media, there's plenty of crap. And that's why good researchers, yeah, you have to use your analytical skills. But if I said, for example, in the past, I only had one source for banking data when I started working, OECD banking statistics, I think it's much better to have too many than too few. But at least you cannot say that you didn't know. If you had plenty of data, you cannot say that you didn't know. If in 2007, the example I gave, we didn't know there was a financial crisis coming because we didn't have the data, that's a scandal. And that was basically it, to a large degree, because we didn't have comparable data. Yeah, I'm very controversial now.
Okay. I'm going to go back and reiterate that Europe needs to harden itself. It's made enemies to the East. And unfortunately, recently with the Nexperia expropriation, antagonized China and disrupted European industrial supply chains by 6 billion components a month. And it's got a frenemy to the West that is constantly looking for ways to sabotage Europe. I think hardening what you can harden quickly is an urgency. So I'll repeat what I called for yesterday. First of all, a pan-EU FX utility for all 27 EU currencies, so that there is a standardized platform for trade, clearing, netting, and settlement efficiently in all 27 currencies. Having built CLS, I can guarantee you I can do this in a year at a minuscule amount of cost compared to the cost of building CLS 25 years ago.
For currency.
That's for currency. Second, I would build an interbank repo utility in all 27 currencies, so that all 27 currencies are liquid against high quality liquid assets in the existing depositories. So that's Euroclear, Clearstream, T2S. I would, that is essential because when the crisis does hit, the most important thing is optionality in terms of getting the liquidity you need when you need it and keeping the system going. Third, I would bring back OTC derivatives from London. 5 years ago, I would not have said that. I would have said it's much more efficient to leave them in London. I think now it's urgent to bring them back and to add a real user case benefit like compression, which you can get at very low cost from the Indian clearinghouse, which, as you say, leads the world in central bank and clearing technologies. And fourth, I'm actually going to skip the International Central Securities Depository because it's going to be outside of Europe. So it does need to be built in Asia or in the Global South because the current ICSDs are gatekeepers who are locking the others out of the system. Fifth, Macron was absolutely right to urge that Europe address the extraterritorial dollar. BNP losing 9% of its share value on Monday, just because in one day, because of another judgment on historic violations, when BNP has already paid, I think it was 4.8 billion in fines. 9 billion in fines. And Europe, you're such a soft target here because you've paid 83% of all fines. You're the softest target. Harden up.
Okay. I would like to thank you all. I think we at 3:35. So he didn't want to make any comment. So thank you, Martin, for joining us, and Katie and Martin have left already. Thank you all for participating to this conference, Iwfsas. I would like to thank co-chairs, Barbara, Sensi Al-Sidi, who couldn't be with us, and Basma Majerbi, who also was not able to join. I would like to thank Yagane very much for the great work of coordination of this conference, and all EMEA team for the support, Dani and Paula here. They've been with us the whole day, the 2 days actually, sitting and managing everything. So really clapping to them. And then Yagane is telling me, Christine, nobody saw her. She's the shadow, but she works the other side. Yes, she was here. So thank you all for this great conference. And next year we agreed with Barbara. It will be in London again. So hopefully to see some of you in London, and yeah, enjoy Barcelona. Will leave you to walk around beautiful areas, and hopefully to see you soon.